Joining us now, Scott Wren, Wells Fargo Investment Institute Senior Global Market Strategist, and Victoria Greene, G Squared Private Wealth Founding Partner and CIO. She is also a CNBC contributor. Guys, welcome. Scott, Q1 was rough, but many were predicting volatility to start the year. So do you stick to the U.S.-centric playbook here, or did new cracks form in the thesis?
Well, John, I think for us, we still want to be U.S. over international, at least for now. I think these, markets, clearly we had a pretty good rally in some of the developed world and emerging world for that matter. But I think those are really ahead of themselves, at least in our opinion. I think the U.S., we're going to have a slowdown here, but the U.S. is going to lead out of the slowdown, and these other markets are going to eventually follow. So for us right now, we saw the retest today. We might get a little bit of a bounce here. We want to buy while we've got a pullback, but for us, it's U.S. over international still. Okay,
now with those headwinds, Victoria, are you playing defense in portfolios, and if so, how?
Yes, I am playing defense right now. I think this is still an extended dead cat bounce. We never had a 90% down day. We never had VIX wash out over 30. I agree, the 5504 holding today, that March 13 intraday low, was big, but we have so much macro that might override the kind of near-term technical strength in the bottoming process. I think we have a little bit to go. I'm not saying this is going to be a massive bear. I just think we have a little bit more downside, so I'm playing defense. Look at who were the Q1 winners. You had AT&T and Philip Morris in the top 5 for the S&P 500. I think defense is going to win the day a little bit right now. I'm staying away from high multiples. I want my cash flows, my good balance sheets, my blue chip dividends. I'm going to hide out a little bit there.
So, Scott, what is it about the U.S. that you think makes it still exceptional from a stock perspective? And I guess just as importantly, given the fact that we have seen this weakness in the mega cap techs, does that actually signal a broadening out of the rally and what you'd be buying right now?
Well, Morgan, we're expecting some broadening out in both earnings and just stock performance this year. We don't think it's going to be another year where, you've got a handful of stocks. Leading the charge. But, when we think about these international markets and you think about the EU or the Eurozone or Japan, I mean, their economies, they're not very flexible. Their productivity's low. Their unemployment's high. They're not really that entrepreneurial. They have a hard time reacting. They have a lot of locked-in regulatory things that really, in my mind, create headwinds for their economy. So even though we've seen lower rates out of the ECB, is that really going to cause European consumers to go out and spend? Probably not, not to any great extent. I mean, they're reliant on export markets, as is Japan. So I think their economies are just a lot less flexible than the U.S. The most innovative companies in the world are U.S.-based, and I think that's what's going to get us through this, and that's what's going to, we are going to have a little bit lower interest rates. We've had some lower interest rates. That's going to take some time. These next couple of months, the uncertainty over the tariffs and some of the things the administration are doing, I mean, that's going to bounce around. But if your outlook is one of moderate growth, moderate inflation, which ours is, you need to take advantage of stocks when they're down. We took money a couple of weeks ago. We pulled it out of the long-term bonds. I think the 10-year yield's too low, and we put that into mid-cap stocks. So we're overweight mid-caps. We're overweight large-cap U.S. stocks. So that's the way we're leaning. We're not getting defensive. We're getting more cyclical exposure on the pullback.
Victoria, so-called Liberation Day is this Wednesday. It's April 2nd. How much is the outcome of Liberation Day going to matter to liberating the markets?
It's massive.
Seasonally, April, especially if you've had a weak March, seasonally, April tends to be pretty strong.
It does. It does. It's, I think, one of the top 3 seasonally strong months that we would like to look at. But, we did see March not perform the way we'd want, or in December not quite follow seasonal patterns. I think this is going to be so much more macro-driven than technical or seasonality. Right now, it's going to be all about what comes out and how sticky those tariffs are. We did start the year saying, hey, tariffs are negotiating. We have developed that thesis and said, hey, tariffs are here to stay. This is going to be a headwind. I mean, the sell-off this morning was Wall Street Journal, was saying, hey, it's going to be 20% across the board. it's 20% across the board, and they're here to stay. That is a very large headwind for consumers, for prices, for inflation. Might not get those 3 rate cuts. And so I look at this and I say, I think this is going to be a pivotal moment. Really happy they're not doing this on April Fool's Day. They were smart enough at least to put it on the 2nd. But for me, it is what comes out, and then how do they follow it up? But listen to the rest of the administration. It's not just what Trump is tweeting, which we know sometimes can be a little bit contradictory, but Bassett, Treasury, Commerce, they're all saying tariffs are here to stay. We're trying to reshuffle the global trade order. To me, that is a headwind that's here to stick that might make the rest of the year a little bit more difficult.